Hello and welcome to our session. This session is about fintech and its role in prevention of the next financial crisis. We'll start from the late 2008, from the first financial crisis. In the global financial crisis of 2008, the traditional banks were the root cause of the problem, as depreciation in the subprime mortgage market in the United States snowballed into an international banking crisis. The failure on the banks gave rise to fledgling fintech, determined to capitalize on growing mistrust of banks as well as the shift in consumer behavior driven by technology advances. Unquestionably, fintech wave emerged primarily from the chaos caused by 2007-8 crisis. Certainly, fintech breeds innovation. In the wake of global crisis of 2020, fintech attracted significant investment and began to revolutionize the financial services. COVID-19 presents another opportunity to advance this legacy. More than a decade after the start of Great Recession, the US economy is still booming. Many fintechs have experienced a surge in demand as working practices and customer banking habits have changed in the COVID-19 era. Technology continues to change the face of financial service industry. The advent of financial services, for example, has created faster, more efficient, and typically cheaper banking compared to the traditional financial services. But on the contrary, there have been numerous cyber attacks surrounding fintech companies in the past year due to their digitalized nature. The acquisition of highly confidential and yet valuable personal financial information, such as credit card details, coupled with their digitalized format, have exposed fintech companies, leaving them vulnerable to both professional and amateur hackers. This session will include a comprehensive analysis of the factors affecting the new evolution of fintech, such as the investment management, customer management, technology, integration challenges, security and privacy challenges, risk management, economy of scale, unique value proposition, and most importantly, its credibility. For that, we are honored to welcome our speaker for this session, Frederik Gregaard, a native of Denmark. Frederik has worked in the professional services and financial industries for 17 years in both Switzerland and throughout Scandinavia, focusing on capital market, digital asset management, private banking, and trading infrastructure. Prior to joining Cardano Foundation, Frederik held a number of management positions and mentored various startups. In his latest role at PwC Switzerland, leading to its digital financial service division in Zurich, he advised regulators and financial service organizations in blockchain's value and helped them build digital business models. Frederik has a great passion for solving tough problems at the intersections of business, experience, and technology, especially in the financial services industry, mindful of how he will change the trust equation of the future generations. Frederik's future goal at Cardano Foundation is to build the Cardano Foundation's adoption strategy through his integration and execution of its mission to enable fast-track value creation for inclusive and equitable growth using Cardano. So we welcome you, Fred. How are you?
Doing excellent. Thank you very much, and thank you for having me on your show today.
You're welcome. It's an honor to have you over here. So, Frederik, I have two questions for you. How is fintech different from traditional financial services, and does the P2P model have the power to prevent the next financial crisis and assist with customer gap mitigation? And also, what areas should be considered prior policy making for fintech industries, considering some best examples in your region that could guide the stakeholders and policymakers to approach an ultimate policy response considering their regional context?
Fintech has actually always been there. So since the evolution of basically banking has been more and more modernized, industrialized, and using more and more technology. So for me, the term fintech is kind of a little bit of a blurred one. And I even went so far the last years to actually talk about that all companies worldwide is now fintech companies. And the reason why I'm doing that is because most companies, like 99% of all companies, are using some kind of ERP system. They're using some kind of computer as a central brain in their operations to do their bookkeeping, to do their business intelligence, to run their operating model, to keep track of the clients. There's really like a digital financial leg all the way out in all companies nearly worldwide. There's only really few companies like native fishermen or some other like small farmers around the globe who's not really jumped on that, and most of them are jumping on it with cheap handheld devices like mobile phones and so on, and have the ability to get the economics of scale there. So in many ways, for me, fintech was more of a small revolution of predominantly front-end people who are saying, we can do this better. But one of the reasons why we haven't seen it pick up as we were expecting it to do was that most of these people were trying to solve the user experience problem and doing some design thinking around that. And the nature of financial service is a bit more complex than that. It has a big regulatory part into it, but it also has a lot of things going on in the engine room, which a lot of the front-end people just wasn't aware of. And what that basically led to was a lot of cybersecurity breaches, a lot of problems with the regulators, a lack of understanding that you only got a bit of the pie, but not the whole pie. Mm-hmm. Basically, what I'm talking about is that with the first robo-advisors, you could trade like 5 ETFs. And you're like, yeah, great, I can get exposure in 5 ETFs for maybe 50 basis points less than my local broker is doing, but it didn't give you the access to true asset diversification or getting into more inclusive parts of finance than you did before. And I think we are going now full cycle that we see the large tier 1 players are being the pressure is not just about optimizing the back end, but it's also around what can we actually do in the front end and how can we change the business models with all these emerging technology coming. So that probably leads into your second question, this P2P model, which is very interesting, right? And that's a lot of what we do in blockchain. And blockchain basically allows you for the first time ever to move value from one person to another person, 100% digital, without having an intermediary. And many of us, we think, hey, I do that every day. I send a transaction using an IBAN number, I key something in on my phone and value moves. But the matter of a fact is that there is, if not 10, then 20 of different counterparties in that transaction. And that's not the same. So the ability we have right now is that we can move value from A to B without an intermediary, really with a trustless system, a global decentralized ledger. And that is truly unique. We've never been able to do that before. And you can think in many ways that the internet, what that did was it made the world smaller. It allowed us to interact and transact with everybody around the world instantly, in no matter what time zone. But the institutionalized trust mechanism was still there. The banks and the lawyers and all of those who allows us to trade with each other without us actually having to do a due diligence on each other and meeting each other and trusting that the other person would deliver on that transaction were still in place. So it was basically in many ways. And what blockchain is going to do now in the P2P space is not even allowing us to move value from A to B, but it's allowing us also to model cash flow patterns and payment obligations in a totally different way. So basically that's what Ethereum did, right? They basically brought the power of the Wall Street to the people without the Wall Street banks. So that means that suddenly we have a totally different way of doing capital formation. And now that's where the policymaker suddenly starts getting a little bit worried. Because if you can do your liquidity and capital formation outside of the regulated players, the banks, then you're going straight into a platform model where people can create marketplaces, so-called DEXs, and they can create products without the control of the regulators. And that means that, some persons will get burned because let's, bear in mind that the regulators work for us, right? They're trying to ensure consumer protection and fraud protection, anti-money laundering, and all those bad things who happens to people when they interact in a very complex ecosystem without having the necessary skill sets to basically understand what exactly they're doing the whole way through. So in many ways, the regulator works for us. And the third, The third revolution we see in the P2P space is now these third generation blockchains such as Cardano, which basically is going to be like an internet of blockchains, a total new financial and social operating system, which will allow us to not just interact, but also transact with people and robots and systems all around the world in a total new way. And that will allow us to come together as humans to actually agree on what the big problems are of this world and react. But it will also allow everybody out there to have access to an infrastructure where they can build their businesses without having the luxury of having huge amounts of capital, or having access to private banks or corporate banking or to specified insurance brokers and so on, right? So it's basically pushing power to the edges of the system, allowing everybody out there to have equal access to financial services and to create their own economic identity. But we do that with about 1.6 million times more effective than the Bitcoin blockchain does, right? In terms of energy consumption and so on. So it's a totally different architecture. And it's basically, you can think about it as a new security architecture of the internet, which also brings a new dynamic of, revisiting what democracy was supposed to be if we had that technology back when the Greeks were inventing it. So that's basically where the P2P economy is going. And in many ways, some of the old institutions like exchanges and so on, they're being kept a little bit artificially alive due to regulation. And that's coming to your third point, I believe, which is policymakers and regulators. What should we be looking out for? And this is where it gets really tricky, right? And this is where it gets very emotional, because now it's not anymore about rationality. It's not about, faster, cheaper, better, more value capture. No, it's really about control. And we don't, to the day of, I don't have a crystal ball and I can tell you what is the best way of having control over our population. Is that to give the control to the individuals? I'm probably more on that side. I'm a libertarian, right? So I believe that everybody should be able to control their own lives and be responsible and accountable for their own decisions and have the tools and the education to do so. But the matter of fact is that not everybody has the luxury of an education to be able to do that, nor are they actually able to be accountable for their own financial actions and so on. The other side of that equation is, of course, centralization in the worst degree, like dictatorship, like one person decides how we should live, and a total, artificial intelligence who's monitoring every move you're doing, right? And you become a part of the system in a control system. And I think, what the regulators really don't like at the moment is that there is still a big narrative around emerging technologies about, specifically around blockchain, which is, if we can do a P2P transaction, we don't have the individuals identified, and there could be happening some fraud or some front running, or there could be certain things happening which we don't want. Marketplaces of illegal goods could emerge, and we cannot track that. So that's a big, scary crow out there. But the fact of the matter is that blockchain actually allows us to monitor and do forensic analysis in a way fiat currencies doesn't do. Just matter of a fact, right? So we have actually more information by using blockchains than if we use the old fiat economy, including the banks. And I can mention 20 of examples of banks doing this. If you look into the other bracket, is artificial intelligence. And artificial intelligence is amazing, right? It has it holds the golden keys of solving all of our humanitarian problems and all of those things. But the big problem about that is what is the learning data. So when you have machine learning algorithms, it needs to learn from something. And if you get it to learn from what we do today, you probably will have not an optimal success in society, because the matter of fact is we don't operate up to the levels which we actually expect others to operate, right? The way we interact and the way we do businesses today is just not optimal. And it takes actually a computer to call out the big card in the mirror in front of us. And if many examples has been done, but when you run the training data on Wikipedia, or you run the training data on just how we talk and interact, you have to kill the AIs because they just go down into a bucket we don't want to be in, right? The second part about AI-powered business models is that most of these AI-powered business models is optimized towards a certain gain. And we need to talk about that, right? Because that's basically the Midas paradox, right? So Midas was this old Greek king, right? So he basically said, I would love that everything I touch just turns into gold. And then turned out that his apple, his food turned into gold, his wife turned into gold, and his whole life crumbled, right? Because gold doesn't really interact with you. Yeah. And the thing with AI is that when you write into the AI that it should optimize towards something, you need to be extremely specific of what it optimizes towards. Most of the large centralized companies today has them optimized towards us, the people who is in the system, that we are the products, right? We are not the consumers. When you get free email accounts, when you get free internet search, when you get free newspapers, you are the product. And the AI is optimizing towards how much time can it get from you and how much data can it get from you that you go into this rabbit hole. And that opens up all sorts of attack vectors, both from a cybersecurity perspective, from a trust perspective, because in the end, you don't know anymore who to trust. It's nearly impossible to figure out what is the truth. I mean, how do you even know what's happening in the world today? It's like if you check 10 websites, is that better than checking one? Do you trust your journalists? Do you trust your government, right? And that's where we're going with the AI economy today. They're simply just optimized toward the wrong thing. And that basically is driving a petition among us as humans. And this distrust, this institutional distrust, which is happening right now, is giving us, is basically setting us in a position where we cannot agree on what the big problems are. So we basically have social unrest and so forth. And when we then go into COVID, right, which is the biggest example of this, right? I mean, it's amazing how many people who still think that COVID is not real, that COVID, is just, a scam from the bankers to earn more money or to trade a correction, or why would I get a vaccine? And the thing is, what they're saying, we need to listen to very carefully, because it doesn't matter if we believe COVID is real or not real. What matters is that this is a behavioral pattern. It's a behavioral pattern of distrust, that people do not trust anybody anymore. And that is what we're getting with this, we used to call it an information age, but it's much more of a misinformation age right now, where we basically realize that we cannot trust anybody anymore. And then we see this big correction we saw last year with the first wave, where everybody was saying from a logical perspective, if everybody goes in a lockdown, businesses will not survive. What then happened was that all the central bankers and all the politicians, we said, okay, no, we have something called monetary policy. We just start the printers, right? We just start printing money and we start, giving money out into the system. And now look and behold, right? I mean, the markets are way higher than they were last year before the crisis, right? So it actually looks like from a financial perspective that the crisis was really good on the economy. The problem is that we're shuffling this, in front of us, that some people actually need to pay back some of these help packages. Not all of these stimulus check is just written out of nothing, out of thin air, right? So we are basically, we're actually living in a situation which we probably haven't seen before, where we have to start asking ourselves, do we even trust the US dollar anymore? Can we trust the euro? What about the Chinese renminbi? Because we know for a fact that if we only have one Coca-Cola available, the price is pretty high for that. But if you suddenly, everywhere we go, there's, soft drinks around, or everywhere we go, there's iPads, and everywhere we go, there is money. And there's so much money in the system. There is no more scarcity, right? At one part, we will see an inflation. And probably what we see today is that the consumer price index, the consumption indexes are probably not priced correctly, right? I mean, everybody is saying that officially we only have about 1% or maybe 1.2% inflation. But I just don't think that's what's happening right now. How can you have 1.2% inflation if we just printed that amount of money? And we have no scarcity and no controls on it, right? We see the stock market booming, even though we see that there's not, there's no other factors turning into it. We see a lot of companies going belly up in Chapter 11, but we still see the stock market booming, right? I mean, this is an unhealthy situation, and the only reason why it keeps on doing it is because all the countries are doing exactly the same thing. So if everybody agrees that now we print more money, that doesn't mean that the value of money stays the same, right? Or it even goes up, right? It probably means that we just have a lot more money in circulation, and that is potentially a really big issue.
Yeah, that's how it's going right now.
The ultimate resource must in the end be the people and not some kind of an AI powered or centralized organization. Let's ensure that we can enable real growth by social growth and not by GDP growth. Let's ensure that the ultimate resource is our brains. It is the ability for us to be creative and build, and not an economic number.
Yeah, it's like that. Thank you so much, Fred. Thank you so much.
You're welcome. Have a great day.
Have a great day. Bye bye.